In one of the more extraordinary moves in the market this week, the world's biggest bond fund, the $240 billion giant PIMCO, decided to sell its entire portfolio of US government-related debt. In effect, PIMCO has placed a huge bet that the Federal Reserve will end quantitative easing in June, and that as a result, bond yields will rise and prices will fall. PIMCO is an influential player, and its move sent a shudder through financial markets this week. So will QE2 end in June, and will there be QE3? And have the trillions the Fed has shelled out for mortgage-backed securities and long-term government bonds been worth it? Well, I asked a former Federal Reserve Governor, Rick Mishkin, who's in town to speak at the Lowy Institute this week. Professor Mishkin, the quantitative easing program at the Federal Reserve started 2 years ago on Thursday of buying bonds, monetising the debt in effect, and since then the Dow Jones has almost doubled. To what extent is that cause and effect, that the extra liquidity and the lower bond yields have resulted in the stock market going up so much?
Well, I think it's first of all slightly differently, which is the Federal Reserve took extraordinary actions during this crisis. And I actually think it deserves a lot of credit for helping avoid a depression, which is we actually came pretty close, and in any case, but avoided the worst problems. The way they did this, of course, is they had two different kind of programs. One was that they had liquidity facilities which were self-liquidating because they were basically lending facilities at penalty rates. And of course, when the financial markets started to recover, then people stopped borrowing. And those are actually now essentially eliminated. The other was that they actually started purchasing assets. And actually, this is much more complicated and in a sense controversial. Particularly important was that they started purchasing $1.25 trillion of mortgage-backed securities, particularly focusing on the fact that the housing market was a key element of the financial crisis. Now we've gone into a different episode where they've been purchasing long-term government securities. So it's not that they were just expanding the balance sheet. We actually know when that's just done, if you bought, for example, short-term Treasury securities, it has essentially no impact. We understand that both from a point of view of economic theory and also actual outcomes that we've seen in other countries.
But how would you feel if you're at the Fed now and there was $1.25 trillion of bonds on the balance sheet? That's a huge
And in fact,
balance sheet.
this worries me a tremendous amount. I've been very concerned about this aspect of what's called quantitative easing. Because it leaves the Federal Reserve in a very dangerous position. And first of all, one of the phrases you used was monetizing the debt. So one of the concerns I've had with the recent bond buying program is that it gives the perception that the Fed is willing to monetize the debt, particularly when the federal government has been irresponsible. In fact, we actually have bipartisan politics in the United States. People don't think so. Both parties have been equally bad on dealing with long-run fiscal issues.
But it's more than the perception, isn't it? It's the reality.
No, I think there's a sense in which, clearly there has been purchases of these long-term bonds. The issue is what they're going to do going down the road. So if the purpose of doing these purchases is to do monetary policy, and it means that when the economy is more fully recovered and inflation becomes more of a serious problem, the Fed will actually withdraw those holdings of long-term securities, then in fact you're not actually aiding and abetting the bad behavior of the fiscal authorities. The problem is that people are not convinced the Fed will do that.
By which you mean, sorry, that the Fed would let the government off?
Right. There's really two phases of quantitative easing. The quantitative easing done during, or what I'd like to call credit easing, because that's what the term that Chairman Bernanke used, that was done during the deep phase of the crisis, was in fact focused on doing whatever it takes to prevent a depression.
But they still seem to be targeting asset prices.
So I wouldn't describe it as targeting asset prices. What I would say that they've been concerned about is the fact that they can't ease monetary policy by lowering the federal funds rate, the cash rate, the policy rate. And so this has actually been focused on trying to lower long-term rates when you can't lower short-term rates any further. So I wouldn't call it targeting. It's basically viewed as another tool of monetary policy.
But in speeches, Ben Bernanke seems to be talking about that, that he's talking, implying that they are interested in getting the stock market up in order to
sure.
improve wealth and therefore the economy.
Sure, because here's the situation the Fed's been in. And from a pure monetary policy viewpoint, this current phase of quantitative easing makes a lot of sense. I have some doubts that this was the right thing to do from other viewpoints because of the issues of potentially looking like you're monetizing the debt, and the danger of having a balance sheet which could leave the Fed exposed to losses, which could then mean that the Congress goes after them, and there's an issue of loss of independence.
So therefore, do you join those who call Ben Bernanke a money printer?
No. So I don't at all. The purpose here is not to, quote, print money and to just not worry about future inflationary consequences. There is, however, an issue that when you have a balance sheet which is this large, and particularly in long-term assets, and even more so in housing assets, the Fed is now involved in the most politicized of all financial markets in the U.S. The Federal Reserve and also the government has been involved in very large transactions to help the economy and bailouts. The government's not going to lose a penny on everything but one. The Fannie and Freddie, a couple $100 billion. So again, this is an indication of how crazy some of our policies have been. Economists we missed a lot of things in this crisis, so we got a lot of things wrong. Much too trusting, for example, of the quality of prudential supervision, which, by the way, in your country was done much, much better than in many other places. So, I don't know whether you're just lucky or good, but maybe both.
So is there going to be QE3, do you think?
So I think the answer is that the threshold for doing QE3 is very high. So it is actually very unlikely. What do you mean by the threshold for the threshold for them to actually go in and do it? And the reason is that QE2 has been very badly received by the markets, by the politicians. When you have Sarah Palin tweeting about the Federal Reserve, complaining about the Federal Reserve, you've got a problem. And I actually think that a big problem with what they did here was they did not couch it in a long-run strategy. One of the things that the Federal Reserve needed to do is to make it very clear that inflation control is the primary long-run goal for a central bank, as you have done in your inflation targeting regime here in Australia, and then couch the use of QE2 as consistent with that, which in fact I think was the intent on the part of the Federal Reserve, but has never been articulated in a clear way, saying also that the balance sheet should be shrunk when we actually need to do so in order to keep inflation under control. So I think that this is a program that will be finished in June. It will not be pursued further. The only wild card could be if, in fact, we start going into double-dip a recession, which I think is very unlikely at this point.
Well, it's a fair bet the stock market will go into a double-dip, or at least a dip.
In a sense, people pay too much attention to the stock market. The stock market tells you information, but it actually may be the symptom of what are deeper causes. So the big problem here was what was happening in credit markets. And the stock market just reflected the fears that occurred as a result of the credit markets. And we know that the stock market goes up and down, and the impact on the economy is actually not that large, particularly if you don't see a credit problem at the same time the stock market crashes. Now, in this case, when we had the stock market fall down to the levels it fell down to, falling basically almost 50%, we had a major credit crisis. And that was the big problem in the U.S. And in fact, the stock market has recovered tremendously, but there's still some problems in the credit market, which are headwinds for the economy. So you've got to be careful. The stock market has some information, but there's this famous quip from Paul Samuelson: the stock market's predicted 9 of the last 5 recessions. So you have to be very careful and recognize that it's only one piece of information. And actually, more important in terms of assessing when you really have problems is when the credit markets get out of whack. And unfortunately, they got out of whack in a big way.
Well, thanks very much for joining us, Professor Mishkin.
My pleasure.